Welcome to Yaka Digital Network Videos. When you look across a sprawling landscape like this, it's easy to see the immense scale of Ugandan agriculture. But zoom in, and you'll find that much of this land is worked by isolated individuals. To produce the cash crops we rely on, like the coffee beans on this branch, a solo farmer has to buy seeds, tools, and fertilizers out of pocket. Buying these inputs individually means paying full retail prices, which reduces potential profit before a single seed goes into the ground. Then comes harvest. A lone farmer producing small quantities usually has only one option: sell to a local middleman. Looking at how this profit margin splits on our dashboard, pause and reflect. Who has the power here? The farmer takes home a fraction of percent, while the middleman captures the majority of the crop's final value. Without a formal credit history, commercial banks rarely offer loans to these individuals. That means efficiency-boosting machinery, like mechanical threshers or irrigation systems, remains out of reach for many. Operating alone traps a smallholder farmer in a cycle of high input costs and weak negotiating power. Breaking that cycle requires a shift in how farmers organize. This table compares two ways farmers organize. Left, self-help groups are informal community networks for mutual aid and shared labor. Right, agricultural cooperatives are legally registered enterprises designed for bulk marketing, industrial processing, and managing credit at a commercial scale. While they differ in their level of formality, both structures provide a mechanism for farmers to improve their profit margins through collective action. The financial engine driving these groups is economies of scale, the economic rule that buying or operating in large volumes lowers the cost of each individual action. For example, instead of 10 farmers buying 10 small bags of fertilizer at full retail price, the group pools its money to buy 100 bags directly from the wholesaler. This bulk purchasing avoids the retail markup, lowering the upfront cost for every member. This pooling extends to human capital. Self-help groups organize rotating labor pools to handle intensive tasks like planting and harvesting as a team. This practice reduces the need to pay for hired hands during peak seasons. And when capital is pooled, expensive hardware becomes viable. A group can collectively purchase and maintain equipment, like mechanical threshers or tractors, sharing access so that every member benefits from industrial tools. By combining their purchasing power and their physical labor, the group reduces the per-farmer cost of production. That combined strength repositions the group in the marketplace. Instead of offering a few sacks of crops to a local trader, the cooperative aggregates everyone's harvest. Look at the volume a collective can amass in a single warehouse. This volume gives the cooperative the leverage required to negotiate directly with commercial processors or international buyers, bypassing local middlemen. Many groups build financial security through a village savings and loan association. Members regularly contribute cash to a central pool. Once grown, the association acts as a bank, issuing low-interest loans back to members to upgrade farms or handle emergencies. Through aggregated harvests and internal banking, collective volume converts isolated farms into a unified, financially independent market force. But managing shared resources involves navigating complex human dynamics, which exposes these organizations to internal risks. If a cooperative lacks transparent financial records or suffers poor leadership, shared funds can be mismanaged. Trust breaks down quickly when money is involved. The group also requires active commitment. If members become apathetic or fail to make their regular financial contributions, the entire system weakens. The financial benefits of the group vanish if internal conflicts or mismanagement lead to collapse. To survive those threats, agricultural groups rely on specific internal rules. This diagram illustrates the 4 structural pillars required to keep a cooperative stable. First is democratic governance, ensuring transparent, one-member, one-vote decisions. Second is capacity building, which means consistently training members in financial literacy. The third is conflict resolution, providing clear rules for handling disagreements. And finally, regulatory compliance ensures the cooperative adheres to the Uganda Cooperative Societies Act. In practice, this means regular meetings where members sit down together, reviewing official statutes and holding their elected leadership accountable for every decision. Cooperatives serve as the economic foundation for rural growth and prosperity. You can watch more videos for all classes here and get all content at www.yaka.cc.